Something just happened that most people completely ignored. No breaking headlines, no market panic, no viral social media storm. But beneath the surface, a single report may explain why gold is exploding, why silver is following, and why central banks around the world are quietly preparing for a very different future. Because for the first time in modern history, America's corruption score just hit an all-time low, and the implications go far beyond politics. They go straight into the price of gold, silver, and the future of the dollar itself. The trigger: America's corruption score collapses. On February 10th, 2026, Transparency International released its annual Corruption Perceptions Index, and the numbers were shocking. The United States scored just 64 out of 100. That's the lowest score in the country by history. A decade ago, the score was 75. In just 10 years, America dropped 11 full points. That's not a small shift. In corruption rankings, that's a structural decline. Even more surprising was the company the U.S. now keeps. It's tied with the Bahamas, below Uruguay, below Barbados, below Lithuania. And for the first time in nearly a decade, the United States is not even in the global top 20. But this isn't just an American story. It's a Western one. 6 major Western nations just posted their lowest corruption scores on record. The global average fell to 42, the lowest in more than a decade. And here's the most telling statistic. Only 5 countries on Earth now score above 80. Just a few years ago, that number was 12. Trust in institutions is collapsing worldwide. The policy shift that triggered the drop. The report points to a major turning point. In February 2025, the U.S. government paused enforcement of the Foreign Corrupt Practices Act for 180 days. This law was designed to stop American companies from bribing officials overseas. But when enforcement paused, everything changed. Cases dropped sharply, the Justice Department redirected resources, and enforcement actions collapsed. In 2025, only 7 cases were brought. Just 1 year earlier, there were 26, and the SEC, 0 cases. Not one. The result was immediate. America's allies stepped in. The United Kingdom, France, and Switzerland formed a new anti-corruption task force to do the job the United States had abandoned. That's a major signal, because when your allies start policing corruption on your behalf, it means confidence in your institutions is fading. Why this matters for gold. Now here's the key question. What does corruption have to do with gold prices? Everything. Because the dollar is not backed by gold. It hasn't been since 1971. Today, the dollar is backed by something else. Institutional trust. Trust in the courts, trust in the government, trust in enforcement, trust in the system. When that trust erodes, capital looks for alternatives, and the ultimate no-trust asset is gold. Gold has no CEO, no government, no balance sheet, no counterparty risk. It's simply value in physical form. Gold's explosive move, and the market is already reacting. On January 28th, gold hit an all-time high near $5,600. Just 2 days later, on January 30th, it crashed. 16% in a single day, the worst drop in history. But here's the important part. The crash didn't last. Gold stabilized above $5,000, and today it's still up roughly 74% over the past 12 months. In 2025 alone, gold set 53 new all-time highs. That's roughly 1 new record every 5 trading days. That's not a normal bull market. That's a structural shift. What central banks are doing. While the public debates politics, central banks are making very different decisions. Since 2022, they've been buying over 1,000 tons of gold per year. That's double the average of the previous decade. In 2025 alone, 22 central banks increased their reserves. Poland added over 100 tons. Its central bank governor called gold a matter of national security. Kazakhstan bought a record 57 tons. Brazil re-entered the market. And China? They've been buying for 15 straight months. But here's the most revealing detail. In 2025, 57% of central bank gold purchases were unreported. More than half of all buying was done quietly, off the radar. That means the people running the system are positioning themselves without telling the public. That's not a coincidence. That's a signal. The 3 forces behind the rally gold isn't rising for just one reason. It's being pushed higher by 3 powerful forces at the same time. And corruption is only the first. Force 1. Institutional decay research shows a direct connection between corruption and economic growth. For every 1-point drop in a corruption score, GDP growth falls by about 1.7%. The United States has dropped 11 points in a decade. That implies a structural slowdown already being priced into gold. The market isn't just reacting to inflation or interest rates. It's reacting to declining trust in the system itself. Force 2, the debt spiral. At the same time, government debt is exploding. The U.S. national debt now sits above $38 trillion. In just 1 year, it grew by more than $2.2 trillion. That's $8 billion per day, 334 million per hour, 93,000 per second, every second. On a personal level, that equals $113,000 for every citizen, and nearly $285,000 per household. And now, interest payments are becoming the fastest growing government expense. They're expected to exceed $1 trillion in 2026, for the first time ever. And soon, interest alone could consume 14% of all federal spending. That's the debt spiral. And historically, that's when currencies start to lose trust. Force 3, de-dollarization. The third force is happening globally. The dollar's share of world reserves is slowly declining, and gold's share is rising. Major asset managers are already calling it a transition to a multipolar monetary system. Today, central banks hold more than 36,000 tons of gold. That's about 20% of their reserves. Just 2 years ago, it was closer to 15%. That's a massive shift in a very short time. And when central banks start increasing their gold allocation, it's usually because they're preparing for a world with less reliance on the dollar. The big shift. So when you put all three forces together, rising corruption, exploding debt, and global de-dollarization, you start to see the bigger picture. This isn't just a price rally, it's a generational shift out of financial assets and into hard assets. And gold is at the center of that move, but gold is only half the story. Because the real asymmetric opportunity may be in silver. So gold is being driven higher by corruption, debt, and the slow shift away from the dollar. But silver sits in a very different position. Because unlike gold, silver is not just a monetary metal, it's also an industrial necessity. And that combination creates a unique setup, one that historically leads to explosive moves. The current silver picture. Right now, silver is trading around $77 to $78. That may sound high compared to old prices, but context matters. Just recently, silver reached a high near $121. So even after a massive rally, silver is still well below its peak. And over the past 12 months, it's still up roughly 140%. That's not weakness, that's strength with room to run. The gold-silver ratio signal. There's another critical metric that investors watch. It's called the gold-silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, that ratio has averaged between 40 and 60. But right now, the ratio is around 65. That tells us something important. Silver is cheap relative to gold, not necessarily cheap in absolute terms, but undervalued compared to its historical relationship with gold. And historically, when that ratio compresses, silver tends to move much faster than gold. Silver's dual demand engine. Silver is unique because it has two separate sources of demand, and both are growing. Investment demand. First, there's investment demand. When gold rises, it pulls attention into the precious metals sector. Investors start looking for value. And many of them end up in silver, because silver is the smaller market. It takes far less capital to move the price. So when money flows into silver, the moves can be explosive. Industrial demand. But here's the bigger story. Silver is also an industrial metal. It's essential for solar panels, electric vehicles, semiconductors, 5G infrastructure, defense systems, medical technology. In many of these industries, silver is not optional. It's irreplaceable. And global demand is rising faster than supply. That has created a structural deficit. And this is now the 6th consecutive year where industrial demand exceeds new mine supply. That gap has to be filled somehow. And the only mechanism the market has is price. The corruption-silver connection. Here's something most people don't think about. Corruption doesn't just impact currencies, it also affects how governments spend money. Historically, more corrupt systems tend to spend more on large-scale projects, infrastructure, defense, energy transitions, technology build-outs, and almost all of those sectors consume massive amounts of silver. So corruption does two things at once. It weakens trust in currency, and it increases industrial demand for silver. That's a powerful double tailwind. The post-crash reality. Remember the major crash on January 30th? That event shook the market. Weak hands were forced out. Leverage was wiped clean. But here's the key point. The fundamentals did not change. Central banks are still buying gold. Industrial demand for silver is still rising. Debt is still exploding. And corruption scores are still falling. So the crash didn't end the bull market. It reset it. What institutions are forecasting? Major financial institutions are already adjusting their forecasts. JP Morgan is targeting gold at $6,300 by the end of 2026. Goldman Sachs has a target around $5,400 for December 2026. And those projections were made before the latest corruption data was released, which means those targets could move higher. At the same time, investor demand is accelerating. Physically backed gold ETFs saw their strongest quarter ever in 2025. $26 billion flowed in during just one quarter. And bar and coin demand hit a 12-year high in the final quarter of the year. That's not speculation. That's real people buying real metal. The big mathematical setup for silver. Now let's look at the numbers. If gold rises to the $6,000 to $7,000 range, and the gold-silver ratio returns to historical norms, silver doesn't just move a little higher, it moves dramatically higher. At a ratio of 60, silver could approach $100. At a ratio of 50, silver could reach 120 to 140. At a ratio of 40, silver moves into the $150 to $300 range. And that's not a fantasy scenario. That's simple historical math. The generational shift. What we're witnessing right now is not just a bull market, it's a generational shift. For decades, wealth flowed into financial assets, stocks, bonds, real estate, derivatives. But now, trust in the system is weakening, debt is rising, corruption scores are falling, currencies are losing credibility, and capital is starting to move back into real assets. Gold, silver, energy, commodities. Assets that don't depend on institutional trust to hold value. The insider signal. And remember that statistic from earlier. 57% of central bank gold purchases in 2025 were unreported. More than half of all buying was done quietly, off the radar. No announcements, no press releases, no headlines, just accumulation. When the insiders start moving quietly, that's usually the clearest signal of all. The final verdict. The corruption report wasn't just a political headline, it was a macroeconomic signal. It revealed a deeper trend. Institutional trust is eroding, debt is spiraling, and central banks are preparing for a different monetary future. Gold is already reacting. Silver may be next. And at current levels, silver represents an asymmetric opportunity, limited downside, relative to the potential upside. Because if gold moves toward $6,000 or $7,000, and the ratio compresses, silver in the $150 to $300 range is not impossible. It's mathematically plausible. Closing line. The system is changing. The insiders are positioning. And the question now is simple. Will you notice the shift before the price fully reflects it, or after?